Hello everyone, welcome back to Forex Rally's webinars. For today, I'd like to start with a quote that I really like, and it comes from Robert Kiyosaki, who said that if you do not know how to care for money, money will stay away from you. And it this can be applied also in trading, and we will talk about things related to this today, and also in day-to-day life. Now, Warren Buffett said, do not put all your eggs in one basket. This is another very important thing to know, because putting all your eggs into one single basket means that you are risking everything on that basket. Usually in trading, and not only in trading, it's not that smart to do such a thing, at least if you are not 100% sure that risking everything on a single side will bring you results. Now, today's webinar, it is about money management, and it's called Trader's Weapon Money Management. My name is Razvan Mihai. I am financial analyst and consultant and partner for Forex Rally. I am certified as financial technician by FTA, and I've gathered over 6 years of experience in technical analysis and trading, and I've written over 10,000 technical and fundamental analysis, and I've done almost 105, actually 1,500 hours of webinars up until now. I didn't get to update this presentation. Now, let me tell you the agenda for today. We will start with which is the biggest problem in trading, and you guys will actually want to know this. After that, we'll get to what overexposure means and how we can avoid this. We'll talk about money management, what it is actually money management. After that, we'll be talking about what is a stop loss and what is a take profit. Now, a bonus for this webinar, I got this in the last 10 minutes before entering the webinar, because it wasn't supposed to be here. It is a surprise for you guys because you've been with me throughout this entire series of 5 webinars. This is the last one. The last one for beginners. We'll have tomorrow a live trading on the release of the GDP, and I've seen that all of you, actually almost all of you, but many more newcomers register for that webinar. It's a live trading on the release of GDP. I'll show you how you could trade on such an important event, what is the money management that you can use, what is the strategy, the technical analysis done before and after the webinar, and the fundamental context will be discussed during the entire webinar. We'll start with an analysis, a thorough analysis, and after that we'll get into the strategy, prepare ourselves for the release, make some trades, put in some pendings or trade at the market, and after that see the results and how it went. Now, let's start with which is the biggest problem in trading. Now, what do you think that it is the biggest problem because of which most traders lose money? As you know, trading, especially on derivatives, on leverage instruments, it is pretty hard to do it, and it is also considered to be risky. So you'll be hearing all over the place that trading is risky, that it involves risk, that everybody loses. Not everybody loses, believe me. I've met traders before I was a trader, before I became a good trader. I've met traders who actually made money from this domain, and they actually managed to convince me that how great the potential is from this, and I started to love trading. I started to love technical analysis, and I've done hundreds of hours, thousands of hours of trainings and researches on the market, on charts, on graphics, on different types of instruments, testing strategies on demo and after that on real accounts, but it paid out. It paid out, and now I think that it is very important for me to give back or to give to others what those traders gave me at that point. Now, I've written here some points. Do you think controlling your emotion is very important or is the biggest problem? You'll be hearing all over the internet. You'll be reading it, or you'll be reading in books, you'll be hearing in webinars that controlling your emotions is very difficult, and this is actually the biggest problem traders have, and that is why most traders are losing lots of money, especially in the beginning. But I don't think controlling your emotions is actually the biggest problem. Let's go on. Lack of knowledge and or education. Now this is a problem. This is a real problem because to trade, to be able to take decisions in a volatile market and in these conditions, and not only these conditions, but in the conditions 2 years ago or 2 years from now, it is not a very easy thing to do, especially if you don't have the knowledge regarding that instrument, regarding the market, the domain. This is actually a business. This is work that you are doing by trading. You need to know what you are doing. You need to understand and to study so that you can take good decisions and have a higher probability of success. So it is a big problem, but it is not the biggest. There are traders who actually studied months or years and they still do not make money on this domain. They are not doing, they're actually losing money while trading, even though they know lots of theories, they know indicators, they know basic, intermediate, and advanced information about trading Forex, CFDs, like commodities, like indices, or maybe equity CFD, it doesn't matter. Now, maybe they know lots of economics or fundamental analysis very good, but they still lose money. Why is that? Why do you think is that? Maybe it's because of controlling your emotion. They are not able to control their emotions. Maybe. But I don't think this is the biggest problem. Now, small balance. I've heard this lots of time. Someone comes in, it's a new guy, it's a new trader, comes into the market, and he usually asks me what is the best balance to get into the market, to start trading with. You know, the answer is not that simple because it depends very much on your investment potential, how much money you actually have, um, and you are able to invest into this domain without being connected emotionally to that amount. So first of all, you need to invest an amount that you can actually afford to lose. Because in investments, nothing, it's 100% sure. It doesn't matter that you are investing on long term, if you are buying bonds or if you are buying stocks, or you are investing in housing sector, or if you, I don't know, invest in art. Nothing, it's 100% sure. No one will guarantee you that you'll have a profit in 1 year, in 10 years, in 20 years. Now this is the same thing as for this domain, but because of the higher leverage, the risk is also higher. So you need to know what you have to do to diminish that risk. So the first thing in investing in this domain is for you to invest something that you can actually afford. So it doesn't matter if it's $10,000, if it's $1,000, or even $100. You can start trades with $100 and you can actually make money. And I've seen lots of traders doing that. Putting 100 bucks, this is the sum that they could afford to invest, making 200, 150, 300 bucks. After that, withdraw, remain with 100, continue trading like that, and they were making money. On a monthly basis, they were doing like 100, 200%, and that was amazing. But they remained at the initial balance. Why? Because they got used to that money, to that amount of money, and they did a really good job using their trading strategies for signals and also another very important thing which I'll be telling you about, and it is actually the biggest problem. So a small balance, it's not a problem. It's not even a problem. So it's not the biggest, it's not even a problem. Lack of discipline. Now, this can be combined with controlling your emotions, because it happens sometimes that discipline should be the most important thing in your trading, because you need to actually wait for the signals, for the right signals. You need to wait to enter the market, you need to wait to exit the market, you need to follow your trading system, the one which gives you signals. You need to follow your trading system when you enter the market, when you exit the market. You don't have to hurry. You should wait and see if your conditions are met. If they are not, don't trade, wait for another setup. So discipline at some point is very important, but it is not the lack of discipline. It is not actually the biggest problem, because at some point you will be able to do that. You just have to follow a system. You just have to follow some conditions, and you will be learning how to disciplinate yourself in this domain. Now, again, what is the biggest problem because of which most traders lose money? From my point of view and from my experience, not knowing how to correctly manage their money is actually the biggest problem. Usually traders, most of traders, and especially those who are losing money, are traders who actually trade volumes they cannot handle. If you will enter the market with a higher volume that you can actually afford to enter, and you'll see loss there, you cannot handle it. You will not be able to handle a big loss. What do you do then? You need to be prepared for this. Usually beginners, I actually recommend for beginners to start with the lowest volume possible. If it's a micro lot, if it's a mini lot, it doesn't matter. But to start with a minimum volume. So this way they will guarantee themselves that they can handle the risk. So starting with the minimum volume, they will build a strategy, they will test, they will know when to handle better their emotions, they will have lots of space for the market to move before, I don't know, you're raising their account. While trading more than you can handle, it will not give you time to actually feel, learn, and understand the market, the movement, and what you actually have to do to make money in this domain. And now I'm talking about real money trading, so on real accounts. I'm not talking about demo accounts, because the difference between the two of them is really, really big. You may have no kind of emotion while trading on demo account, but when it comes to real money, and especially if it's your money, you will see that emotions are rushing in and will actually make you take wrong decisions. You'll be entering the market too late or too soon. You'll be exiting the market on the wrong point. You'll be increasing your loss, even though you could have stopped it a long time ago. And this is not the ideal scenario. Or you will usually stop your profit at the wrong point. You'll have lots of small profits, and it's enough to get one big loss to erase your account or to erase all your profits. And this is not a good strategy. Now, because I told you guys about trading volumes that you cannot handle, and I told you it is better to start with the minimum volumes. In the beginning, start with the minimum volumes. See how it goes for you, see how your strategy works, see if it is applicable on real accounts, see if you can handle the pressure, and after that you can increase the volumes and step by step get to the volume that you can actually trade, make real good money on that volume, but also which allows you to lose a certain amount of money without being disappointed. let's say the best word would be disappointed. Now, this is called trading more than you actually need. It is called overexposure. So you'll be hearing this a lot. Lots of traders get overexposed in their first day of trading, especially trading on real accounts. They are trading too much for their balance to support. So many traders tend to trade a volume too big for their account because they don't have a money management system, and we'll be discussing about money management, and I'll show you how to calculate your risk and how to adjust your volume in such a way that your account will actually be able to support a loss, and a loss which you actually set. That's very important. When we'll get to stop loss, I'll show you how to set a stop loss, and to respect that stop loss is very important. Now, to not risk getting caught overexposed during your trading, you should avoid being greedy. This is my first point. And why did I write here avoid being greedy? Let me tell you something that happened to me, and I've seen that it happens to many of my clients, past clients, current clients, and I'm sure that future clients too. It happens that at some point they get to have a good strategy. They actually have a good money management system. They have good results, but because they are usually right, let's say 70% of the time, or maybe more. In the beginning, you'll find it surprising, but you'll actually get to be right 80%, maybe 90% of the time. It's not a surprise for me now because it happened. It happens. In those moments, you will tend to increase your volume. This is one of the biggest mistakes. If your account doesn't allow you to increase the volume, don't do it. Don't do it, because at that point you'll get overexposed, and if the market will go against you and you are not prepared to lose because your mindset up is focused on winning, the mind will tell you, no, 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 it can't be. You are 90% of the time right. This time you will also be right. And you leave that loss, and you'll actually get to margin call. And I don't really like to say this, but margin call is painful. I've had it 3 times in the beginning, and it was painful. The thing is that when you get to margin call, you get blocked. And not with the money because you lost money or anything else, but with the fact that you actually got it wrong that time. So please, and I'm now begging you, please avoid being greedy. Take it step by step, and if the balance will allow you to increase the volume, increase it. If not, try to stay with that volume as much as possible. Another point is avoid revenge trading. This is very important. You know, at some point you'll get, as I told you, to understand the market, to understand its flow, to trade good, and maybe something happens and you get a loss, or you get several losses. You have a 10%, 50%, maybe 20% drawdown. And at that point, your human being will start to think in this way: revenge yourself with the market. The market, it's not actually, it's not the market's fault that you took a wrong decision at some point and you lost money, because the market moves. It doesn't really know what you are doing on your account. So you are fully responsible for the decision that you take at a point in time. So don't do revenge trading on the market. Revenge trading means that you will increase your volume to gain back what you lost from the market, thinking that you will get into a good position next time. That's not good. That's not profitable. That's not a good strategy maybe it can be on short term, maybe on one trade you will manage to get the profit back, but on medium and long term, on a series of trades, you will not have that probability in your favor. So don't do a revenge trading. And now I'm gonna tell you a short story. I'll try to make it short because it's actually a pretty sad story and it's quite long. It happened that at some point I was working with, I was actually a technical analyst and coach for another brokerage house several years ago, and a VIP client came to me to manage its account. Now, first of all, I got to know that guy and see what is he doing, what is his status, how is his money coming in. I got to know the guy, and I accepted his proposal to manage his account. But I told him that I'm not taking risks, especially because it's his money. So I'll have a very low risk appetite. So I'll be more than, um, let me tell you values because it doesn't matter how I am. I told him that it's because his money and I would like to know him and see how the collaboration go. I will not be able to do more than 5% a month for him, at least in the first 6 months, because this way I can diminish my risk, see how the market goes, see how the account evolves, and after that maybe I can increase the volumes and increase the profit. 5% per month, it's pretty okay considering the interest rate for the many of the countries, or especially the big economies like in the Euro area or United States, Japan, and so on and so forth. 5% per month, think that it's almost 60% per year. So it's way more than you can get from putting your money to a bank. It's way more. So it should have been okay. But the thing is that this guy, this client of mine, actually saw the potential of the market. He saw that he could actually win more if he risks more, so if he enters with higher volumes. So he started trading on himself. And at some point I said, okay, it's enough. I will not trade anymore on your account because I see that you are taking decision by your own. He was losing, winning. It was somewhere on break even. I washed my hands. I let him trade. After 2.5 months, he came to me that he actually lost $1,000. So $100,000. This was his initial loss, and he uh, topped up his account with another 50,000. I said, okay, let me coach you a bit. Let me show you what's about technical analysis. Let me show you about fundamental. Let me show you a bit some strategies. Maybe you can use them, because he was still going to trade on his own to get back the money that he had lost. So I made some coaching with him. In the time that he was listening to what I was saying to him, like don't get overexposed, look for the signals, get a bit, have patience, enter the market at the right point, exit the market at the right point. He did very good. He made again 3 to 5% per month, but after that he tried to get even more. And fast forward, at some point I was actually writing him analysis and he was trading based on my analysis, and he actually managed to, with high risk of course, on those analyses he managed to double his account in 4 hours. So he was a very short-term trader with high volumes, but combining this with very good analysis and very good entries and exits, so entry point and exit point, he actually doubled his account. I told him, okay, it's pretty much enough for today. Take a break. I need to do something else. I need to take I need to actually do I had to do a webinar, so I told him take a break. We'll be doing this next day again, and we'll try to get back your money with this system. I'm doing analysis, you are trading. So perfect combination. I'm not involving my emotions in, and you are actually listening to what I am doing. If you want to take the trade, you take it. If not, not. Well, he didn't stop there. I had my webinar. I left home from work. I had some other stuff to do, and I looked after 4 to 5 hours on his account. He had actually lost everything he won and 80% of what he had in his account when I started giving him analysis. So at that point I said, okay, you didn't listen to me once when I tried to manage your account. You didn't listen to me when I did some coaching with you. You didn't actually listen to me when you saw that we actually doubled the account in less than 4 hours, and I don't think I can do anything else for you. He did both. He was greedy because he saw that he was making money. He doubled the account in less than 4 hours. So he continued to do that. But it's not a strategy. The probability is like that in trading. The more you win, the higher is the probability for you to start losing. The more you lose, the higher the probability becomes for you to start winning. And he had won a lot. It was a high probability for him to start losing, and this is what happened. And while losing, he actually did revenge trading. So he actually increased his volumes, even though his account didn't permit him to do that. So he had lost 90% of what he had at the end of those 4 hours. Now, this for me was a big, big lesson that I taught myself. So I knew that there were risks. I did it in the beginning, 6 years ago when I started trading. I wasn't perfect. Nobody is perfect. And believe me, every good trader, actually every trader who makes money in this domain at this hour, in the beginning he lost at least one account. Why? Because he didn't listen to those who were teaching him. And this is what happens. Even though we know what will happen to us, we'll still get to choose the wrong path. I don't know why. I did it. I did it myself. So I don't know. I will not be able to explain you why, but we are doing it. So either because we are not listening, either because we are not actually learning something from our mistakes. Now, if you do it first time and you do it wrong, then that's a mistake. If you do it the second time and you get it wrong, that's a decision. So you guys be careful. I'm trying to give you as much as I can from my experience. I think that if you will listen at least to 10% of what I'm saying in this webinar, you will have a perfect trading career. Now, let's go on and see what is actually a money management. But before that, I want to tell you another thing. I did a poll among 200 traders from different websites from this domain, like TradingView, like Forex Factory, like Baby Pips, so forums mainly with traders, and 200 traders actually answered to my poll, and 87% of the winning traders, because one of my questions was if they are winning or losing in medium and long term, there were traders who actually answered pretty fair, and they said that they are not yet winning, they are losing. So I took the ones who said they are winning, and I know a big part of them because I got to interact and discuss and see their knowledge and balances and so on and so forth. 87% of those winning traders said that their most important tool in trading is actually their money management, and their money management is actually applied on the trading system which gives them signals. Now this is very important. If 87% of the winning traders said this, it means that is actually a very important tool and you will want to learn more about it. Now let me go on and say something about money management. I define money management as being a tool used by traders to adjust their risk on a certain trade or series of trades. This way they will diminish their risk. Now, traders can diminish their risk in different ways, but they can diminish their risks per one trade. What does this mean? If you will take a trade, you will want to set yourself a maximum risk, a maximum loss that you will take on that trade. Let's say you have an account of $10,000 and you will not take a loss bigger than 5%. Now you'll see that in books, on the internet, on different blogs, or other traders, they will tell you that a bigger risk should not be than 5%. So you should take a loss between 3 and 5%. Now, I am a trader who actually takes a risk of 1% per trade. So I'm not going higher than 1% per trade. I can go on 4% per trade, but that is my maximum. When I'm going to 4% per trade, that I actually not know for sure, but I trust that trade, that position. And this is very important. So you can go up to 10% loss per one trade if you actually know and you actually have arguments and reasons to take that trade with that big risks. But you can adjust the risk. You can adjust it from volume. So if you need, let's say, let me get in here the platform. I have a euro dollar instrument, but I'll use it just to give you guys some examples. Now, let's say you want to trade from here. So you want to enter the market at this point, and you actually target a level of 117.90 or 180.18, the next trend line. But you will need a stop loss here at 105.15. So it means that you will actually need a stop of almost 400 pips. Actually more than 400 pips. It's 460 pips, 66 pips. It's a very big stop loss. But if you know that you have to put the stop loss there, and that's the level at which your scenario is invalidated, then you can adjust the volume to decrease the risk. Instead of losing 466 pips at a volume of 1, which actually means 4,660 pips. So trading one standard volume on the Forex market means that you actually get for 1 pip 10 from the second currency currency of the pair. So if you are now talking about euro dollar, for each one standard lot, meaning $100,000 traded, you have per 1 pip $10. So 466 pips multiplied by $10 per pip, it means that you will have $4,660 loss if your stop loss is hit. But you cannot afford to lose $4,600 if you have an account of 10,000. Maybe you would like to lose only 466, which means 4.6% of the account. In this case, you will have to go down with the volume to 0.1, and this way you'll have 0.1, you'll have $1 per pip, $466 per the stop loss. Or if you want to go even lower than that, you can actually go to 0.05 and you will get 200, or actually yes, $288 if your stop loss is hit. In this case, you diminish the risk. You will have a low risk, or actually a lower loss, a smaller loss, $288, but you will, no, I'm sorry, $233, but you will also have a smaller profit, because if now you would have had with one lot $8,030, because we have here 803 pips, you will only have $415 and $401.5. So you diminish your risk, you diminish your profit, but if your probability is for the trade to take profit, don't go there with the risk too. So losing $4,660 means that you will actually lose 46.6% of your account. Think of that. You make two trades of 46 and you have your account in margin call. But if you are actually doing a trade with a 2% loss, how many times do you have to lose in a row to get margin call? 10, 20, 50 times. So if you have a 2%, then you'll have to lose 50 times in a row to get to margin call. What's the probability for you to lose 50 times in a row? It's pretty much the same probability for you to win 50 times in a row. Good. So I think I made my point with this. Let's go on and see the next point from our list. Series of trades. So you can set a risk per one trade. Let's say you set a risk of 2% per one trade. But you can also set a risk per a series of trades. Let's say if in the next 10 trades you lose 6%, you'll stop and take it back from tomorrow. You'll start tomorrow again and do this your strategy, apply your strategy and trade. So this means that you will not stop at one trade. You will actually take a series of trades and see what happens in that series of trades. Why? Because the probability for you to get to this 6% in the series of trades is lower than in one trade. Because, you know, as I told you, if you lose more times, the probability for you to start winning increases. So if you will have just one profitable trade and you actually respect the money management, which says that never, and I talked about this in my past webinars, never get into a trade if your profit is not at least 1.5 times higher than your possible loss. So if you are actually accepting a loss of $10 or $100, you will want to gain from that trade at least $15 or $150 at least. A very good money management system would tell you that you will actually need 1 to 2 risk to reward, or 1 to 3. Now, in books you'll find lots of information regarding money management, and lots of them will tell you that 1.1 to 2, 1 to 3 risk to reward is actually the best. Well, it's not actually the best. You'll see that the most close to reality is 1 to 1.5 or 1 to 2 risk to reward. And this came out from my poll too. So those traders, winning traders, I mean, they were actually having a risk to reward close to 1 to 1.5 or 1 to 2. Or a risk on a period of time. So let's say we take 1 week and you say, if I reach a 6% drawdown or a minus of 6% this week, I'll stop when I'll get to that. Or when I get to 6% profit on this week, then I'll stop and take over next week. This way you will set a maximum risk for a period of time. So I've actually get to know traders using all of these or each. So traders who actually set a risk per trade. I met traders who set a risk per series of trades, and I've actually met traders who set their risk on a period of time. Myself, I'm using the first one. So I'm setting a risk on my own one trade, and I am calculating stop losses. I'm adjusting the volume from that trade. So the higher is the level of stop loss, the more pips I need for the level of stop loss. To find myself in my maximum loss, I will have to diminish the volume. Let's say I'll need the 10 pips stop loss, then I can go with a higher volume. So if I usually trade one lot, but this time instead of 20 pips, which I usually use as a stop loss, I only need 10 pips as a stop loss, I can double the volume. So I can actually trade two lots because my final risk, my final loss will be the same as trading one lot with a stop of 20 pips. So I think you guys got me. And uh, by the way, I forgot to tell you, and it's my bad, but I know that you got used to my way of doing the webinars. If you guys have questions, please let me know during the webinar. I can see your questions in my window, and I will answer to you right away. I think from my perspective, from my experience, is the best way to do it. Great. Now let's go on and let me tell you guys what is actually a stop loss. I'll just give you the definitions, and I'll show you on the platform how you can actually use in trading these kind of stop loss and take profits, because it is the next type of order. So stop loss is a level at which the trade will be closed automatically by the platform with the loss set by you. A take profit is the level at which the trade will be automatically closed with the profit set also by you. So because it's more important to practice a bit, I got back to my trading platform. This is Xstation from Forex Rally. So as you can see, I have now here the euro dollar chart with the daily time frame. I'll lower it to H1, so this is actually 60 minutes chart. I'll just look a bit over here and see what's happening. And my technical analysis on short term says that it would be okay for me, even though I don't have the final signal, so I'm a bit hurrying in taking a decision. But my guts and my analysis says that it is okay for me to take a short here, so to make a sell trade. Now let me show you how you can set a stop loss and a take profit on a trade. You either go here and make a market order, so I want to sell. I'm selling 0.1 at this level, and you can see that if I click my order, two lines will pop up. The blue one is stop loss. I can set my stop loss at, I don't know, let's say 30 pips. In my case, I think that I can set it on 20 almost 20 pips above the high, and set a stop loss. As I told you, the best way would be for me to set a stop at least 1.5 times higher than my loss. So I like to have it 2 times, and I'll get it to 40 pips. Actually, I said I want 40 pips. 40 pips, meaning that I need to have a take profit at 109.33. And as you can see here, the platform tells me that if my take profit will be hit, I'll take a profit of $40.30, while if my stop loss will be hit, then I'll take a loss of $19.5. I accept the modifications and this is my trade. So at this point, if the price will continue to increase and it will reach 109.93, and I mean now the ask line, not the bid one. We have on the platform now the bid. If we put the ask, it will show us another line. Let me zoom in a bit and show you. So I have the white line here. This is the bid, and the ask, which is the price at which we can buy. So now click my order, you'll see stop loss here, take profit here. As I told you, I am ready to go and leave my computer. Why? Because first of all, this is on cloud, so I can go to another computer, or I can log in from my mobile phone and see these orders, change them, make modifications, close them, and so on, or open others. But the most important thing is that I took my risk. I set the stop loss at 20 pips and I set my take profit at 40 pips. So now I'm good to go. I don't care what happens. I'll come back in a couple of hours, or I'll look over the charts 3 hours from now and I'll see how it went. Maybe my take profit was hit, or maybe my stop loss was hit. But I took the loss that I wanted. So never leave a trade without a stop loss. It is good for you to have at least a trailing stop if you don't have a take profit. A trailing stop means that you actually have a solution for moving automatically the stop loss. But I recommend you to move manually the stop loss, because some things are better done like that, and especially with stop loss. And I'll tell you on my next slide why, and at that bonus I've told you about. So now getting back to this is the way I set my stop loss. It is pretty simple. I make a trade, click on that trade because it's on the chart, and after that um, set visually my stop loss and my take profit. I can also do that from this. This is the terminal. This is the window at which I actually can make modifications on my trade. I can change my stop loss. You can see that I can change it in pips. I can change it in value of and price. So I can set it at instead of 99.3, I can set it at 99. Let me show you 4. Click OK, and it was modified. Or I can set it, as I told you, in pips, 20 pips, minus 20 pips, because this is actually a stop. And you'll see that I have the value also in dollars. So I can set to lose, it was before $19.50. So I will set it like this. And my stop was moved. The same thing happens for take profit. I can set number of pips, I can set value, or I can set the amount which I would like to earn from this trade. It is as simple as that. This platform, this is why I like the X-Station. It is very simple, it is very intuitive, and you can actually change your orders, modify them, close them very easy. You can close this order from the chart, or you can close it from your terminal, from here, from open positions. But mainly, I love it because it is very easy to set a stop loss, to modify it, to set a take profit and modify it. If I want now to go with a profit higher, I just have to drag and drop. If I want to get it further away, drag and drop, approve, and that's about it. So this is how I can actually set stop loss and take profit on the platform. This is the easiest way. I can show you at least 3 more types. So I can actually go on euro dollar, open my ticket. So if I want to do another trade, set here the lot, or if I want, I set the margin, or let's say the contract value. I'd like to trade 100,000, so this means one lot. Or if I want to trade, let's say I want to block in my margin $550 means 50,000 for the contract value and 0.5. I can set my stop loss from here. So if I set my stop loss value, or I can set it in pips or in dollars. I can also see the spread lower, and I can see the pip value according to my volume, the volume that I've set up here. So it is pretty intuitive, and it is pretty easy to use, and it is very, very appreciated by traders who actually do lots of trades, or they need speed, or they need to do a trade very, very fast, because they have this click and trade from the chart, they have this click and trade from here, and after that they just click on the level of their position and modify from the chart the stop loss and the take profit. So this is a thing that I really love. I'll let this trade here and see if I was right in the decision I made in less than 30 seconds. So I just looked over the chart and I saw that the price got pretty far away, and it may be the time to correct. So I set the stop loss above the current high, which is pretty close, and I set the stop loss, this time it is pretty big, 80 pips. I don't think it will drop that much, at least not over the night on the Asian session. So I would actually get this closer to 30 pips. So 30 pips, it is pretty reasonable at this point, and I think that euro can actually drop 30 pips after it rallied that much during the day. Good. So I've said this trade, I can leave it here and walk home. No worries, I'll look tomorrow morning on it and see what actually happened. Maybe my stop was hit, or maybe my take profit will be hit during the night. Good. Now I have one more thing for you to tell, and it is position managing. I told you that this is a bonus slide that I added for this webinar, because it is the last one from this series, and I think that after the one of tomorrow, live trading on GDP, don't forget about that. Oh, by the way, let me show you something very, very nice, and this would be a pretty good reason for you to understand why I like to do live trading on a GDP release. GBP USD. Today the GDP was actually released, and look at the volatility here. Look at what the market did. First of all, it dropped. The GDP was released. It had a gap, went all the way down, and after that started to rally. Now this was a very interesting psychology of the market, because the GDP, the current GDP released today, was lower than expectations, but the past one was revised up. So it was a pretty weird thing to do, but I saw it in lots of occasions. So the market went on the direction of the release, of the current release, but after that went and followed the general idea that it was for the revised GDP. So the market went up. Pretty nice, pretty clean moves. I don't really like this gap. I hope tomorrow we'll not have a gap, because gaps are not really easy to trade, and they will jump your level, and if you don't have price, you will not have your position open at that price, and you'll have the position open at the next price of the market, especially if you have pendings. And on releases, you'll see that I have a strategy which actually includes pending positions. Good. Now, getting back to my presentation, as I told you, add to position will be my first point of this slide. So what do I mean by add to position? Let me show you. Let me get back to my station and let me show you. Let's say that I was trading from here. So I was actually waiting for, let me see the entire chart. Oh, this is so nice. This is so nice. So a very nice technical analysis here. You can see that the price got all the way down to the trending line, and after that started to move up. This was nice. I would have usually waited for the price to break this level, this resistance from here. It was a local and key resistance for the price, as you can actually see. And let's say that we would have traded on the breakout. So we would have entered the trade here with a volume of, let's say, 1. So here I had already opened a 1 volume trade on buy. I would see that the price moves up and after that sideways, and I would set myself a resistance here because I know that this is actually a corrective move. So knowing that this is a corrective move, and if it doesn't break this 152.52, let's say I would have had a stop loss around this level. I was just waiting for the price to break again this this trend line, and I would have added to my initial position. I have one lot here, don't forget. I would have added another 0.5, let's say, or 1, depending on my balance. So another 0.5. In my case, at this point, because the market is still increasing, I can see that it is testing 153.35. A break above this level would actually trigger for me another buy. So I could enter the another 0.5 in the favor of this move. So waiting for a move towards 154 maybe. So this would be a strategy of adding to your initial position. So you have entered on the right direction of the trend. Why not, as long as you have positive signals that the trend is continuing, to enter that trend, to enter with more positions on that trend. So this is a strategy. It is a position strategy combined with money managing that actually increases your profitability. Okay, now let's get back to our presentation. Another one would be partial close. Now let me get back to the X station and take the same example. Let's say that in my case, I will delete these. Okay, same chart. Let's say for a given reason, I would have sold here. So this is a short position. Now if I would have sold here, I would have waited to see if my stop would be hit. In this case, my stop would be around here or higher. I usually take several pips above the latest high, depending on the context, depending on the market price action. So my stop would have been here. It wouldn't have been closed, and as you can see, the price got all the way up here and started to drop. Now if I would have seen that the price got back to this level, where I can see that it was a very good support, I wouldn't risk not getting some profits out of that trade. So here, if I would have opened one lot, I would have closed 0.5 at this level. Why? Because it is a good support and there is a high probability for the price to get back and maybe hit my stop loss. So it's better for me to take out half a position, take in some profits, and maybe take the stop loss and move it on break even. This would be the best thing to do. And after that, this means manually trailing stop. So you actually moved your stop on break even or on 1 pip plus. Now, a second trade would have been, or exiting the another trade would have been at this 151.89 because it was a next resistance. So if the price hit this level, I would have either got out of the entire position, so close another 0.5. You can actually close partial volume. So if you go here, let's say double click, and you set here 0.05, you can actually close 0.05 of this trade. Now I will not do this because I'm waiting for the euro to drop and I'm keeping my first strategy. I don't have a reason to close it now, but this can be another position managing strategy. So you actually get into the market with a volume, but when you have negative signals regarding your position, it's better to get some money in-house to cash in some money from that trade. It is safer to do it like that. It is safer to actually see your money in balance and not risk losing them again as it happened here. So you can see that the price hit, after that was bounced back all the way to the resistance, to my entry level, and got here. So here I would have actually closed half of my position and wait for the next move with my stop loss on break even at this point. Good. My last point of this slide of position managing is trailing stop. It's something I've told you about already during this webinar, but I'll show you now what I actually mean by trailing stop and what is actually really cool to do, and you'll see that you'll save yourself lots of money while trading. So let's say you have a reason, and we can always find a reason to buy. In this case, we have lots of reasons, like here a piercing line on a support really close to a trend line. So lots of reasons to buy at this level. We bought here after this piercing line. It is a candlestick pattern was confirmed. We bought on this level, let's say one lot of euro dollar, and waited to see what happened. Well, the price actually rallied all the way up here and started a consolidation period or a correction move. Well, at this point I would set my stop loss under these lows. So I would set a stop loss at 152.68. Why? Because this is a low. If this low would have been broken, then I think that the price could have dropped back to 152.40 or lower than this, and maybe cancel my full transaction, my full profit. So why would I do that? Why wouldn't I get out of a trade if I know that there is levels which actually invalidates my scenarios? So I would have set the stop loss here. Now, because the price moved even higher than that, now I would actually take my stop loss and set it here to the next low. So if I have an uptrend, I would set my stop loss under the local low. If I would have a downtrend, so let's say this one here, I'll just deselect auto. If I would have entered on a sell here, I don't know, it doesn't matter the reason, I would set my stop loss after that here. I would have went with it here, with it after that here, so I have a high. On a downtrend, I would go with the stop loss on the highs, on the local highs. This is the safest thing to do. Now, this is what I had to tell you about money managing and about money management in trading and in Forex trading. I gave you guys some things from my experience regarding position managing, so it will help you in your day-to-day trading. I hope that you will apply this every day on your demo account and see how it goes, because you need to test these strategies. You need to test your signal strategy, but you also need to test your money management strategy to see what are the probabilities to get into good trades and make money from trading Forex. we'll see each other tomorrow at 1 a.m. CT and do a pretty nice webinar on live trading at the release of the USGDP. It is a very important economic release for this month, and after that, at that webinar, we'll actually use everything that I've taught you guys in these first 5 webinars. I'll be talking about technical analysis, I'll be talking about fundamental, I'll be talking about context, economic context, I'll be talking about money management and strategy, and we'll see what kind of strategy we can apply on that specific price action and get into some trades. I don't know what will happen because the market is it can be highly unpredictable at that point because of the volatility, but using all our knowledge, I think that we can get the probability in our favor. Thank you very much for attending this webinar. My name is Razvan Mihai. I wish you all a good night, and we will hear each other tomorrow at the live trading webinar. So see you guys then.